2. What the three financial statements actually tell you. 3 documents, 1 business. Every company that reports its financials publishes 3 core statements at the end of each reporting period. Each statement answers a different question about the same business. The income statement asks, did this company make money during this period? The balance sheet asks, what does this company own and owe at this moment? The cash flow statement asks, where did the actual cash go during this period? Reading all 3 together gives you a complete picture of a company's financial condition. The income statement. The income statement covers a specific period, such as a fiscal year or a quarter. It starts with revenue at the top and subtracts costs step by step until you reach net income at the bottom. The items in between reveal how much it costs to deliver the product or service, how efficiently the company controls its operating expenses, and what remains for shareholders after interest and taxes. For example, in fiscal year 2025, Microsoft reported total revenue of $282 billion and net income of $102 billion. The gap between those 2 numbers shows all the costs the business incurred to generate that revenue. The balance sheet. The balance sheet captures a single point in time, such as the last day of the fiscal year. Assets are everything the company owns or controls that has economic value, including cash, receivables, property, and intangible assets. Liabilities are obligations the company must settle in the future, such as loans and accounts payable. Equity is what remains for shareholders after all liabilities are subtracted from total assets. As of June 30, 2025, Microsoft held total assets of $619 billion, total liabilities of $276 billion, and total equity of $343 billion. Part 2. The cash flow statement. The cash flow statement covers the same period as the income statement. It is divided into 3 sections: cash from operating activities, cash from investing activities, and cash from financing activities. Operating cash flow shows how much real cash the core business generated during the period. Investing cash flow shows how much the company spent on assets like property, equipment, and acquisitions, or received from selling them. Financing cash flow shows how the company raised or returned capital through debt issuance, debt repayment, dividends, or share buybacks. In fiscal year 2025, Microsoft generated $136 billion in operating cash flow, spent $65 billion on capital expenditure, and paid $24 billion in dividends. Why profit and cash are never the same. Net income and operating cash flow are almost never the same number, and understanding why matters. Microsoft reported net income of $102 billion in fiscal year 2025, but operating cash flow was $136 billion. The difference came largely from non-cash items added back to net income, including $34 billion of depreciation and $12 billion of stock-based compensation. Neither of those items required any cash to leave the business, but both reduced reported profit. On the other side, when a company sells on credit, it records revenue immediately, but the cash arrives later. That timing gap between recognizing income and receiving cash explains why analysts never rely on profit alone. Part 3. How the 3 statements connect. The 3 financial statements are not independent documents. They share specific numbers that link them together into one integrated system. Net income from the income statement flows into retained earnings on the balance sheet, which sits inside shareholders' equity. If net income is positive, retained earnings increase and equity grows. If a company reports a loss, retained earnings decrease and equity shrinks. The ending cash balance shown at the bottom of the cash flow statement must match the cash and cash equivalents line on the balance sheet exactly. If those 2 numbers do not match, there is an error somewhere in the reporting. How analysts read the 3 together. Analysts typically begin with the income statement to assess whether the business is growing and generating profit. They then move to the balance sheet to understand how the company is funded and whether its financial position is stable. Finally, they examine the cash flow statement to verify whether reported profits are backed by real cash generation. For example, a company may report strong net income but show negative operating cash flow, which signals that earnings are not yet converting into cash. That kind of gap between profit and cash is only visible when all 3 statements are read in sequence. This top-down flow, from income to position to cash, is the standard starting point in equity research, M&A due diligence, and credit analysis.